Hello, everyone. Thank you all for coming out. Excited to be the first speaker today. Let's have some fun. We're going to learn a lot. This panel is an incredible mix of credit-based markets that you're going to learn from. We have Teller, we have Resource Network, we have Maple Finance, and I'm here to show you a little bit about what unsecured lending will be in the DeFi space. So with that, I'll start the video, please. And we'll kick off with a good morning, and we're all going to make it. So let's begin. What is Teller? Teller is a credit risk protocol that's meant for people to launch unsecured lending markets. And for that, we can really revolutionize what DeFi has become today. A lot of DeFi has been this world where we've proved that assets sitting in a smart contract can make value. You can code value on top of money, which is incredible because no one's been able to prove that in traditional finance. But how do we remove collateral? And we do that with reputation. Reputation brings in the ability for you to price in risk accurately. And that risk is how we're going to be able to untap the next universe of liquidity in DeFi and really make DeFi feel like fintech today. That's the wave that all the projects who are going to be speaking here today are going forward with, and that's what people are excited about. So today, I'm going to show you a demo of the Teller platform, and we're going to go over how you can remove collateral necessities with reputation. So this is a demo of the Teller platform. You have two types of loans that you could select, unsecured and secured. With an unsecured loan, you can connect your bank account. So call that Chase, Wells Fargo, Bank of America, and you can get an unsecured loan today. The other type of loan is secured. And for us in DeFi, that may mean over-collateralized, but actually with the Teller platform, you can have down to 20% collateral. This is a form that should feel very familiar to people, kind of like a rocket mortgage. This is something where you're going to enter what you want. Talk about the type of loan that you want to get access to. You select the asset, the amount of DAI you want to borrow, the loan size, and then in order to get access to the loan, you have to connect a bank. So connecting a bank account is going to be one of the next unlocks in DeFi, where we're going to be bringing in real-world information to better price and analyze risk per consumer. So this is the process of connecting a bank account. We work with an infrastructure provider called Plaid. Plaid gives access to 100+ different bank accounts that you can connect to in over 7 different countries. So if you are in the States today, you can do this live. There's PNC, Citibank, Chase. We'll show you logging into Chase. And what will happen in the background is that data is going to go from Chase to the user's browser. And this is a major shift in how you'd be getting a loan in the traditional world today. With DeFi, we have smart contracts that can automate the movement of money. And everything that happens in your traditional space or with your interactions online should be the same way. So here we've just connected the bank account to the user's browser. And at this point in time, no data has been seen by anyone. The data remains private. The user has their data. And that's very important because we should own our data. And that's going to be one of the next major unlocks for the remainder of DeFi, or for the next generation, next leg up of DeFi. Fintech today takes the consumer's data, they process it, they house it, and they then use it to price in risk. But a lot of that stays centralized and localized. In this next world of risk assessment, which is what will be coming to DeFi, we're going to see private data be used in ways that will unlock resources for any type of borrowing activity that a user wants. And that's going to be specific because where you want to use the money matters. And that's going to matter in the risk assessment. That's going to matter in who you are and what data is being come to in order for you to access these loans. So the beauty here is that this type of DeFi-based liquidity can be accessible directly from your browser. You connect your bank account. You didn't have to go speak to someone in person. And you click on your loan terms. Here's an example of a loan, an interest rate of 17%, a loan size of 100 DAI. And this loan is short. It's only for a day. So I'm going to accept those terms. And mind you, everything today has actually happened without smart contracts, just on the user's browser. At this point, the smart contract has agreed to these terms. So I just submitted those terms on chain. And it's telling me if I want to get this loan at 17% for 100 DAI, I need to just check off that, hey, I'm not putting in collateral. Let me submit that request. And after that, I'm able to actually get the loan to my browser. Now, this is kind of crazy. It's an aha moment where anyone today who's sitting in this room that has a bank account can get access to capital through DeFi. It's autonomous, and it works through smart contracts. So like I said, there's no banker in the middle of you getting access to your loan. And here you'll be able to see all the different loans you've taken out and what you must repay. Now the question is, how do we expand this globally? How do we go from the 7 countries supported today with these bank integrations to an entire universe of data and reputation? Well, that data can come from something you own. And we've actually done a pilot and a test case of how you can use NFTs as your reputation. As we all saw, Visa put a CryptoPunk as their profile. We know that these are going to become like Rolexes. You're going to use NFTs in the DeFi world as a place to say who you are. This is me and this is my reputation. I want to borrow against that reputation. And here's an example of how you can do that. So on the Teller platform, we have launched a fortune teller collection of NFTs. And these are financial capable or utilizable NFTs where you can actually get a loan with the NFTs. Those NFTs over time can build you reputation points. They can build you credit. So we launched 3 different tiers of NFTs that get you different loan sizes. And based on the NFTs that you buy or you own, you start with a base loan amount. In the future, we see a world where NFTs and using them in the DeFi ecosystem will build you credit. From being a good actor and paying back over time, you create a proof that your identity and what you've done in the space matters. So here, I've staked an NFT to the smart contract, and that's going to allow me to borrow against that NFT. I'm going to select the loan size I want. Like I said, this should feel like Rocket Mortgage. So here I'm selecting a loan size of 100,000 DAI for 60 days. But if you look at the NFT I have, my base line of credit I can get against it is 2.5K. So in order for me to access that capital, I will have to lower the actual amount I want to borrow. But what does this mean? This means at the start, I have some loan amount. As I take out the loan and I repay it, the value or reputation of the NFT itself increases over time. So just like play to earn with Axie Infinity or what's going to come out with Illuvium, this is a real-life example where NFTs can function as one of the metrics of your credit history. Here I'm going to request my loan terms with that NFT. Currently, the NFTs themselves don't carry an interest rate associated with them. But as you borrow and as we know more about you, that's when those type of unique models of risk assessment can come alive. And you can do this today. This is live. You can buy an NFT off OpenSea, stake it into the protocol, and you can use that to take out a loan. This is requesting that loan. This is happening live on Mainnet in this demo. And you're going to see, once the transaction is confirmed, if I were to go to Etherscan, you would see the NFT that's then staked in the smart contract and my loan that's been taken against that NFT. Now, something to point out. The use case of the loans is very particular. And that's how unsecured lending will evolve in the space. Many people think that unsecured lending means money must go directly to your wallet. But that's not how all of unsecured lending works in the traditional space. You have buy now, pay later programs. You have credit lines, credit cards. You have mortgages where the funds are backed against a different type of collateral, being a home. That's how the use of funds will evolve in the DeFi space as the under-collateralized market evolves. Here's an example of me using those funds in Compound. So I took out a loan of 1,000 DAI. I'm going to deposit them into Compound. And on the loan that I'm taking out against my reputation, where I'm not charged interest, I'm now depositing into Compound, and I'm going to be earning interest and the Comp token from the Compound protocol. So this is an example of how people in DeFi will be leveraging these type of assets and your reputation to go yield farm, to go buy NFTs, to go do anything they want in the metaverse of our crypto world that we live in, and be able to access that capital without the need to have collateral, without needing money up front. This is how we unlock the next phase of DeFi. This is how we bring the next generation in. And it's going to start very surely at today's inflection point. We have a place where DeFi has grown into a massive industry, and you can access capital today, but you need capital. This is the next unlock, and the question will be, what will you do with that capital? Will you go put a down payment on a home? Will you go spend it like you would normally with a debit card or a credit card? Will you buy NFTs? Will you go leverage, or will you go use it in DeFi today? Any type of use cases you want will be coming forth in the DeFi ecosystem, and we're going to see a world that feels a lot like traditional finance today. And DeFi is really going to become the underpinnings of everything we know in the major economy, all the way from debt to equity to real estate and beyond. So that was my talk. Thank you so much for coming today, and I hope you have an incredible day and experience at Mainnet.
Thank you so much, Ryan. That was a great presentation. Up next, we have Varun Kumar presenting on Hashflow. Varun.
All right. Everybody. Ready? Hello. Good. Hi, this is Varun here from Hashflow. And first of all, I'd like to thank the Messari team for giving us this opportunity to speak here and present what we've been up to. So Hashflow is a decentralized exchange, and we've been working on bringing institutional liquidity into DeFi. Now, what that means is if you're a retail investor, you can lend your assets to earn LP fees through institutional market makers. And if you're a market maker, then now you have the ability to bootstrap inventory of assets and market make and generate yield without having to lock up capital in a particular pool. And if you're a trader, then you're able to basically get the prices that closest to the fair market price and be able to trade with tighter spreads. And because all the quotes are being generated by market makers are being signed through off-chain pricing logic, you're able to get quotes that are not really incurring unexpected slippage that you would see in AMMs, or be able to be vulnerable to MEV attacks or sandwich attacks or front-running and such. So I think we can start the video. And what we'll do is we'll walk through the 3 use cases. First one is the trader experience that you're seeing on the screen at the moment. It shows very much the same Uniswap-like vending machine experience where a user can enter a quote and then receive the quote. And once you click Submit Order, you should have the quote issued to you by the market maker that is cryptographically signed. So you just confirm the quote on MetaMask. Right? And this is one of the experiences I think you may have already seen if you've used Hashflow, and this is currently live, and you can go and trade. And the good thing is, anything you see on the screen is what you actually end up executing. You're less likely to run into any of the MEV attacks or anything else. Now, the second experience we can walk through is the market maker experience itself. What does it look like from a market maker's perspective? So the first one is obviously you create a pool, right? So there's 2 types. There's a private pool and there's a public pool. So creating it, you can name your pool, and then the signer address essentially tells you the cryptographic key you'll be using to sign the quotes. So at any given time a quote is submitted by a trader, it's always verified by the smart contract that is owned by the market maker. For this experience, for this demo, we'll focus on public pools that allows more fun things like allowing any retail investor to fund these pools and take advantage of the yield being generated by market makers. Right? So this is the flow you're seeing where a market maker is able to deploy a pool, set the signer key, set the basis points fees they want to charge on each trade, and submit the quote. So once again, this is happening in real time, except we haven't published the public pools public to everybody. We've been staging the sequence in which we'll do the launch, and this is something we'll be announcing in October, but this is a sneak peek of what we can expect once they go live. So that is. So that's the first pool that got deployed and got created. Obviously, there's no volume, there's no portfolio value yet. But if you're a market maker, once you have this, you can simply go there and add assets that you would like to trade. And in this case, we'll do a Ethereum, and we'll set the cap that dictates what's the max capacity the pool can handle at a given time, and then list that asset before anybody is able to go and start funding the pool. And that's confirmed. We'll do something similar to another asset. So essentially what's happening is the market maker has the ability to set capacity of what is the max cap of inventory they would like to take at a particular time, and then use that inventory to hedge their risk across CeFi and DeFi venues and keep the pools balanced. So we'll do something similar for DAI as well. So again, set the capacity to $1 million in DAI and confirm the transaction. So this, in general, is a public pool experience, right, on how you create a pool if you're a market maker. And once the pool is listed, we can actually go refresh and see if the DAI was, once the transaction gets confirmed, we can just go and then check to see the pool would be listed in the list of pools. And once we go through the public pool experience, next thing we can take a look at is a more exciting part where a retail LP gets to go and fund one of these pools and then see how the yield can be generated. So as you can see, now there's a pool, and it has two assets, ETH and DAI, that we listed. And you can also see them listed in the main category. The third one is, it was a fun little thing we were doing. You can ignore that. So anyway, the third experience we're going to look at is the HF trading pool. As you can see, the pool balance currently, when we deployed a couple of days ago, was 300K. And the volume at that time was 1.7 million, where the TVL was 300K, so the turnover rate was about 5x. And what I'll do is I, as a retail investor, will go and lend some of the DAI to this pool. So at the moment, the pool TVL is 315K. The volume was fluctuating up and down on September 8th, but at a total of 1.7 million. And it had a asset distribution of DAI, USDC, and USDT. I'm going to go and add 100 DAI to it. All right, so anyway, so essentially what you could do is you could add multiple assets, obviously, but in this one, we're going to go with DAI. And then, so what's going to happen here is I'm adding funds as a retail LP to a pool that is controlled by one of the professional market makers who's running the pool. So I'm essentially a lazy LP who's contributing capital and then hoping that I'll earn yield. And this is akin to traditional market making, where you lend assets or an inventory of assets to a designated market maker who then uses those funds to do market make and then return yield to the asset issuer. And it's the same capacity. And now what we've done is we've added 100 DAI to the pool, and then we'll wait for 24 hours, not physically actually, but then in the video we'll fast forward 24 hours, and 24 hours later, you could see my investment in the HF trading pool. And you can see my balance. I earned 11 cents over a 24-hour period, and that adds up to an APY of 40%, given the pool balance is about 316K. And the volume actually went up in that 24 hours period to 3.1 million, which was essentially a nearly 10x turnover rate on the assets we had. And if we compare to Uniswap pool, where we have like 5 bips fee on a USDC DAI pool, it's actually, we're able to generate 5x less yield, but with 100x less capital on the same thing. And now you can go essentially and withdraw the same funds. Right? So what we saw is we're able to generate nearly 35% yield on an instrument without even having any tokens. So that essentially alludes to the new era of capital efficiency in DeFi, on what we could do with a limited amount of capital, and how can we leverage this capital to build a much more better market structure. Right? So and here we essentially did a removing of assets to basically capture the yield within a 24-hour period. So I think that should wrap up the demo of the public pools. But I think that was a fairly quick one, and thank you very much. Yes. Excellent.
Thank you, Varun. Next up, we will have Graeme Moore from Polymath. Welcome, Graeme.
Hey, everybody. I think we can just start with the video right ahead. So I'm Graeme. I'm the head of tokenization at Polymath, and today we're talking about the who, what, where, why, when, and how of the Polymesh mainnet launch, and we'll also see a demo. So when mainnet, everybody always wants to know when mainnet, but not everybody asks why mainnet. Why did Polymath decide to build a blockchain for security tokens? And we had some success in the past. We created the first self-serve product on Ethereum to create managed security tokens, where there's been 225 tokens created. We spearheaded ERC-1400, which is the most widely used security token standard in the world. Consensus has their own implementation. The government of Norway has experimented with it, and soon to announce, a top 10 global bank will likely talk about their use of ERC-1400. And so, why mainnet? Ethereum was never built for security tokens. We started building on Ethereum, and we kept hearing time and time again, especially when we talked to larger financial institutions, there were 5 big problems: governance, identity, confidentiality, compliance, and settlement. And so we kept looking at these problems, and we said, okay, well, we need to build our own blockchain for security tokens. A few final things we had to wrap up before we could go live with mainnet: the formation of the Polymesh Association. So that's a Swiss not-for-profit member-based association that provides resources to support the advancement and adoption of a diverse Polymesh community. Polymath is just one member of many, and it has 250 million Polyx to achieve its goals. An interesting aspect of Polymesh, all the node operators are regulated financial entities. And so a few we can talk about today. There's 14 to start, but a few we can discuss: Entoro, Oasis Pro Markets, DigiVault, the Gibraltar Stock Exchange, Blockson, and Etonic Custody. And so these are geographically distributed all around the world. And then finally, we launched an incentivized testnet a little over 5 months ago. And so we've had 4,300 plus users onboarded to the chain, and they actually have to pass a KYC process to get onboarded to the chain. And they've been helping us fix bugs, fix our UIs, and really make Polymesh the best experience it could be. Huge shout out to F. O'Brien and the rest of the Polymesh community for helping us do that, because it's been a huge help. And then finally, pre-mainnet launch, there will be 2 successful independent code audits. One is back. I believe one's coming in the next day or 2. And so before we get to one mainnet, we'll discuss what's Polyx. Polyx is the native protocol token for Polymesh. And so if you have a Poly token that exists today as an ERC-20 token on Ethereum, you can upgrade that one-to-one to Polyx on Polymesh. And so that mainnet bridge will be there for at least 1 year following the mainnet launch. There's no new supply of Polyx on mainnet, other than staking rewards, of course. So it's a proof-of-stake blockchain. And then probably the biggest news, other than when mainnet, is that Polyx is a FINMA-regulated utility token. So for those who don't know, FINMA is the financial regulator in Switzerland. They bucket assets on blockchains into 3 categories. It's either an asset or security, or a payment token or a utility token. So based on their current opinion, Polyx fits their definition of what a utility token is. And so drum roll, if there's any drummers in the audience. Anyone? Drum roll, please. Cool, awesome, thank you. Hey, Polymesh mainnet is scheduled to go live on October 13th. So in just a few weeks from now, users can start upgrading their Poly on Ethereum to Polyx on Polymesh. They can start staking, earn staking rewards to secure the chain. They can create security tokens, manage security tokens, invest in security tokens, and also engage in governance on chain. And so that's one mainnet, but of course this is the demo track, so we need to know, okay, well, what is mainnet? What is it going to look like when people eventually onboard to Polymesh? And so we'll take a look at a demo right quick for a few minutes, and we'll start with the bridge process. So we have our Polymesh wallet here, which everyone's probably familiar with. MetaMask functions very similarly. So right now we have our Polymesh ID with our Polymesh address. I'm going to upgrade 10,000 Poly tokens to Polyx. You can see there's a 30,000 limit there. That's only on testnet, so there's no limit for mainnet if anybody is wondering. And so I'm confirming the transaction on the Ethereum side of things, which will go ahead and lock the Poly. Of course, I've sped this up for TV. This takes a little bit longer than a couple seconds. And so now, success, I have my 10,000 Polyx on Polymesh. So I have my Polyx. I want to go create some security tokens. So first step here, I'm going to reserve a ticker symbol. It's called the MNT token, or mainnet. And so I'm confirming that. And if you see here, the network fee is 0.1 Polyx roughly. So this is several orders of magnitude different in terms of transaction fees for what exists on Ethereum today. That transaction on Ethereum with our technology can cost anywhere from $20 to $100. It is now orders of magnitude less. here I'm configuring my Mainnet token. It's a common equity. I can specify if I want there to be decimal places or not, so I'm going to make sure that there are decimal places. I can input references, so if people want to know where the golden source of truth of the private placement memorandum is, for example, it can live within the token itself. So I've configured MNT successfully. Here's some other functionality. I can send ownership of that and control that to a transfer agent or a broker-dealer or someone, but I'm going to go ahead and set up my compliance criteria. So I want to make sure that anyone who holds the MNT token is KYC verified. They're either an accredited, an affiliate, or an exempt investor, and they must be from the United States. I'm also going to enforce buy lockups and sell lockups on my token, and that's a lot of what Polymath has been about for the last 4 years, is ensuring that you can implement actual compliance criteria on blockchains. And so I've set up that rule, and now I'm going to add myself as an approved attestation provider. So approved attestation providers are able to make attestations about users who want to invest in the MNT token. And so I've added myself, but I could also add my KYC provider. I could add my transfer agent. I could add a broker-dealer, a custodian, even another exchange. And so I've added myself as an approved attestation provider, and now I'm attesting to a potential investor. Let's call her Alice. So Alice has a buy lockup that actually turned off a couple days ago. She's got a sell lockup for about a year. She needs to refresh her KYC information a few months from now. She is in the USA, and she is also an accredited investor. And so if you remember when I set up the compliance criteria, Alice, the attestations I've created about her actually fit with the compliance criteria. So Alice will be able to hold tokens. However, if any of the criteria did not fit with the attestation I created about her, she would not be able to hold tokens. So again, the issuers and their partners in financial markets being able to maintain compliance, not only in the primary market, but also in the secondary market. So I've just minted 1,000 MNT tokens, and I want to go ahead and distribute 250 of those to Alice. And so I'll call the distribution event Q3. I can do it to just Alice's address, but I could also do 50 at a time with a CSV file, or I could plug into the Polymesh SDK and write a script and mint tokens to hundreds of people, thousands of people. And so I'll go ahead and do that, and we'll distribute the 250 tokens to Alice. If you pay attention here, you see waiting for receiver that just popped up at the bottom of the screen. So Polymesh, fundamentally different from every other public blockchain that exists today because it's built for security tokens. And so we're looking at Alice's view of things now in her dashboard, and she actually has to accept that token transfer. So that concept does not exist on any other blockchain. If I want to send you tokens on Ethereum, you cannot say no. But on Polymesh, we have actual settlement. And when you start talking to large financial institutions, that's very, very important. The sender of an asset must affirm settlement instructions, and the receiver of an asset must affirm settlement instructions. So Alice has affirmed that. She's received her 250 mainnet tokens. Now she's going ahead and creating a portfolio that she's called US Common Equity. And so she can send those mainnet tokens into the common equity portfolio, and then she can also delegate someone else to control those on her behalf. So maybe a transfer agent, a custodian, an investment advisor, whoever. But Alice still maintains the ultimate beneficial ownership criteria. So again, very important when you start talking to financial institutions, how they view this space and what makes them comfortable with blockchains, especially for regulated assets. And so Alice is done investing in MNT tokens. She wants to go ahead and earn some staking rewards by providing security to the Polymesh chain. She's going to go ahead and stake 500 PolyX. She could stake on one of the node operators, or she could stake on a bunch of them. She's going to select all of the node operators that she wants to stake on, and an algorithm, so it's nominated proof of stake, decides sort of which operator it's staking on at any point in time. So she's going to confirm here with her wallet, and then she's off to the races. So you can see her projected daily rewards, weekly rewards, and monthly rewards as well. And so that's it in terms of the demo aspect. One of the really cool things about Polymesh is if you want to build something on Polymesh, you can go ahead. So we've taken care of all the heavy lifting of building a blockchain for capital markets, and then we've also built an SDK on top of the blockchain. So very, very easy if you want to build your own token studio, your own staking interface, your own application for a custodian, you can do that by plugging directly into our SDK. And so if anybody has any questions, feel free to reach out. Here's how to get in touch with me, and then also how to follow along with the rest of the project. So I hope everybody's excited for the mainnet launch of Polymesh, the blockchain purpose-built for security tokens. Thanks.
All right, thank you, Graeme. Next up, we have a presentation demo from Ashley Taylor at Resource.finance.
So thanks. Resource is a protocol for business credit. It's under collateralized, and we launched the first network using this protocol this summer in Asheville, North Carolina. So we're going to start with the demo. So Resource is a Web 2.0-like experience for logging in. So when you log into Resource, you're using a non-custodial wallet, but a lot of our users have no experience with crypto. They don't know crypto is going on in the background, so it's really important that the first time that they're interacting with it, it feels like a product that they're used to using. So the business, when they are onboarded to Resource, they get a credit line. Their credit line is in Resource dollars. Resource dollars are like the US dollar, but they're only used within the network. And when they're actually minted, is not outside of the system. It's actually when they make a transaction within Resource with any other business. So you can see here that I have a credit line of 1,000 Resource dollars. And then you can see that I've spent 28 Resource dollars. And I've spent it with these other businesses here. And that was actually when the Resource dollars were minted. So we didn't need USDC or fiat anywhere to actually create the Resource dollar. And then you can see with the other businesses that I've made a transaction here in my wallet, and we can actually take a look at my balance. So this is our negative balance wallet. It's a new token standard that we developed on the Celo blockchain. So that negative balance, I actually pay back with sales to other businesses in the network. So this is my my profile that's shown in the marketplace. I'm a handyman. I do graphic design. I do interior design and build. And when people buy from me in the network, that's how I actually pay back my negative balance that you see in my wallet here. So we think we're the first negative balance token standard. And then you can see my different purchases and actually who I've been transacting with in the network. So I've been buying fair trade cacao from Guatemala. And then this business, actually, because I've bought from him, I don't have to pay back my sales by him purchasing from me. It can be from any other business that's part of the network. So this is a purchase on the Resource network. So if I wanted to buy cacao beans, I would actually be doing it here. And since I have a credit line of 1,000 Resource dollars, I'm able to purchase these, even though I didn't already have the Resource dollars created. So this is actually creating a transaction here, where I'm sending a Resource dollar, to the cacao business, and then we'll see how it confirms. So this is actually happening on the Celo blockchain network. And this is like for the first time for many businesses that are actually having a crypto transaction go through. So it feels, a little bit like we're getting into the blockchain confirming transaction, but it still feels like an accessible experience, which is really important to us for the businesses. And so I'm going to be going to my wallet, and then you'll see in the wallet where I now have a new transaction that's shown. And for the people that want to dig in, they can go and check out how it's actually listed on the blockchain. And then also I'm able to now message with the seller and figure out shipping and fulfillment. And so seeing it on the Alpha Horus testnet on the Celo blockchain. So Celo was the first partner that we decided to work with because it's, as you saw, transactions are cheap, they're fast. So for the first introduction to blockchain for businesses, it's a really accessible experience. So now, to talk about some of the businesses that we're working with, we launched in Asheville, North Carolina. It's a really independent small business community. This is an example of one of our partner businesses. They're called Blue Moon Water. So they do spring water delivery to different homes and businesses in the area. And they got a credit line that they pay back by selling water to other businesses in our network. What they're using Resource for is actually benefits for their employees. Their employees are getting like massage, acupuncture, organic food delivery for their work office or their home office. And then Blue Moon Water is increasing their customers by using Resource for other businesses in our network that then are now able to purchase water using Resource dollars, which means then they're saving their cash flow, getting new customers. There's also tax benefits for working with this. And we're basically building a network of these types of businesses in Asheville. North Carolina. We're starting to do a similar expansion in the Bay Area. So now we're going to talk about how do you decide who gets a credit line and how actually does that function. So we're back to our cacao business, and we're now taking the viewpoint of an underwriter in our system. So the underwriter is crypto savvy, so they're able to connect their MetaMask, and then they're able to see different businesses that they could underwrite. So you could search for the business that you're looking for, or you'll have a feed of new businesses that need a credit line. You can see what they've been doing in the resource network, the different transactions that they have, the different people they've been transacting with, how long they've had a credit line, et cetera. All the different people that they've been transacting with, how often they have. And then you're able to stake our utility token, and you stake it for 20% of the credit line that you're giving them in resource dollars. So it's partially collateralized. We have other methods of being able to perform for defaults if that's needed, but we think it's important for under collateralization, building upon that credit actually is issued that way in the traditional world. So our partners for being able to issue this type of credit, we're actually working with Teller, making use of their relationships that they're developing to bring certain data privately on chain to our underwriters. So then our underwriters can then securely make decisions about credit lines to give out. And so why do they want to give out credit lines? They earn the transaction fees from the businesses that they've underwritten that are transacting within Resource. So our current status, we are releasing a private alpha of this underwriting DApp to our underwriters in a month, and then we'll be launching it more publicly later on this year. And we're currently expanding with the businesses, as I said, in Asheville, North Carolina, and the Bay Area, and then similar other locations like that. And it's also open for freelancers or people who make products that they can ship remotely or deliver remotely. Thank you very much.
Thank you, Ashley. For our final demo for this session, we have Sid Powell from Maple Finance.
We can roll the video. Hi there, my name's Sid. I'm the co-founder of Maple Finance. Today, I'm going to tell you a little bit about what we built, why we built it, and a sneak peek at how it works. So to take a step back, my background was debt capital markets and traditional finance. So I used to help companies to raise corporate debt so that they could reinvest in growing their businesses. And as I went to work for a company and do that myself, I then started to think about how we could harness the transformative power of blockchain to connect global capital with opportunities around the world. That was the kernel of the idea for Maple Finance. And so what we've built is an institutional capital marketplace on top of the Ethereum blockchain. On one side, we connect crypto native companies with under-collateralized loans so that they can reinvest in growing their businesses. On the other, we provide a yield opportunity for lenders in stablecoins in Maple pools. Now, we have backing from some of the most prominent VC firms in the space, including Framework, Alameda Research, Polychain Capital, and DeFi founders Kane and Stani from Synthetics and Aave, respectively. We launched on Mainnet in May of this year with a first pool of $17 million. And since then, we've grown 10x to 172 million in deposits and over 180 million in loans done to date. So how does Maple actually work? It's really simple. You have three participants on the protocol. So you've got lenders who deposit stablecoins in pool to earn a yield. Then we have, these are predominantly institutions. About 80% of the deposits in Maple are over $1 million in size. Then we have pool delegates. Pool delegates manage Maple pools. So each pool has its own pool delegate. They perform credit assessment on the borrowers and agree and approve the loan terms to them. And then we have the borrowers, who are crypto native companies who are borrowing under collateralized so that they can expand their businesses. These are usually companies with north of 50 or 100 million in assets under management, and they tend to be among market makers and market neutral funds. So we have in our ecosystem at the moment relationships with some of the largest crypto native market makers. As we scroll down and see those participants, you can see that we've built up relationships with Alameda Research, Amber Group, Wintermute, as well as high frequency traders Folkvang and Nibio. You can also see on this ecosystem panel two of our pool delegates who are Orthogonal Trading and Maven 11 Capital. So next, let's take a look at why lenders actually choose Maple. So first and foremost, what's really important to them is the strength of the counterparties that they're dealing with. So as I mentioned, having built those relationships with the largest crypto native funds has served us well. The second point they're looking for is, of course, capital preservation. So this product, lenders are not taking directional risk on crypto asset prices. Instead, they're just providing USDC, and it's a fixed income product. The third element that's really important to them is the sustainability of the yields. Ultimately, these are cash flows generated by crypto native companies who have found product market fit, they have strong balance sheets, they are profitable, and they're cash flow positive. This has enabled us to win the support as lenders of some of the largest funds in the space. These include Dragonfly Capital, CoinShares, Blockchain.com, as well as funds Nascent Capital and Spartan Capital. So now we're going to take a quick look at what the app actually looks like from the perspective of a lender on the platform. So from here, a lender who comes to the web app is able to view both of the pools that are available on Maple. You can see that from a standing start in May, we only had the orthogonal pool. That has now grown from 17 mil at inception to over 100 mil now. It's very important to us that we provide transparent stats on the loans in that pool and the performance. So from here, a lender would click into this pool. And one of the important ways in which we differentiate ourselves from CeFi lending platforms, which are akin to a black box if you're a lender. You don't know who's borrowing on the other side. You don't know the source of that yield, is of course transparency. So the pool delegate would here publish the strategy they're pursuing. In this instance, this pool is pursuing loans to market makers, market neutral funds. And then it's very important to us that we also provide statistics here on the performance of the pool. You can see how many loans have been done, how much interest has actually been earned by the pool to date, as well as cash balance and total pool balance. So that's very important for lenders to build trust in our platform. Similarly, in that vein, as we scroll down, you'll be able to see that we also provide a table of all the borrowers who are active in this pool. So if you're a lender, you can see that you're benefiting from the quality of these counterparties, as well as the level of diversification. You can see exactly where all of that yield is coming from, who the counterparties in this pool are, and the terms on which they're borrowing. You're also able to see in real time the performance of all of the loans in this pool, extending right back to the inception of the pool with all of the loans that have since matured. So this is really important. So to recap, what lenders want is transparency, the quality of the counterparties. They know that this risk is being managed properly through diversification and transparent performance reporting. So if you're a lender, we've also designed this to be self-service. So from this page, if you have USDC in your MetaMask or other wallet, you can connect to the app and then hit deposit there, and then you would stake your LP tokens so that you receive rewards. But from here, you can actually manage your whole position. So you can claim interest, you can claim your Maple token rewards. You can also exit the pool after 90 days, should you choose. But we've found most of our institutions choose to roll their position. So from here, if you're interested in finding out more about how this works, you can go to the homepage. We have a Contact Us page. If you reach out via there, the team would be happy to connect, set up a call, or answer any questions that you have. If you have questions afterwards, we'll be available and handing out some merchandise. Thanks for your time.